Lately, everyone's been asking, with the Middle East erupting into all-out conflict and the US and Iran completely falling out, is the US stock market about to crash? Should I liquidate all my mutual funds, stocks, and retirement savings right now and run for the hills? Friends, don't panic and don't rush to click that sell all button. For the vast majority of ordinary people, the first reaction to war news is extreme panic, and the second is to rush in and buy gold at inflated prices. The result is often that the missiles didn't wipe out your money, your own reckless trading wiped out half your account. In today's video, we won't talk about empty rhetoric, about great power rivalry. We'll just talk about money. If the US-Iran conflict really escalates, what hidden mechanisms will drag the US stock market down with it? Looking back at wars over the past 50 years, what hard-learned lessons has Wall Street identified? And as an ordinary person at this turbulent juncture, how should you position your money to both protect your capital and make a profit? This episode is incredibly in-depth, because when fear grips you in the market, this foundational logic will help you keep your composure. Part 1. Understanding the essence of the conflict. This isn't the Second World War. It's a pressure cooker. Let's first clarify the fundamentals. What exactly is the current state of affairs between the US and Iran? For many people, the image of war still involves millions of troops lining up along a border and then opening fire on all fronts. In reality, it's nothing like that. The current situation between the US and Iran can be described in one phrase: high intensity, asymmetric proxy friction. It's like a pressure cooker that's been simmering on the stove for years. The US holds absolute air superiority and possesses aircraft carrier strike groups, while Iran controls the arc of resistance spanning the Middle East, the Houthi rebels in Yemen, Hezbollah in Lebanon, and a host of various militia groups. No one wants to completely shatter their own pressure cooker, but everyone is frantically jiggling the pressure valve. You bomb one of my outposts today, and I'll send a drone to tap your base tomorrow. You sanction my oil, and I'll harass your cargo ships in the Red Sea. So, as investors, we must first cultivate a desensitized mindset. Don't let yourself be led by the nose every day, by the breaking news, escalation, and shocking developments in news alerts. Because this tug of war and testing of boundaries is the new normal for the Middle East. But if this is the norm, why are the bigwigs on Wall Street still so nervous? Section 2. The market's fatal weakness, not missiles, but oil prices. This brings us to our key transition. What exactly are the US stock markets, or rather global capital markets, afraid of? In reality, Wall Street couldn't care less about which desert a missile lands in. They're fixated on a single 39-kilometer wide choke point on the map, the Strait of Hormuz. This choke point is the lifeline of the global energy supply. Every day, 1/5 of the world's oil and 1/4 of its liquefied natural gas must pass through here. Follow this line of reasoning carefully. If the conflict escalates, even if the strait merely experiences a decline in transport efficiency or a spike in insurance premiums, international oil prices will skyrocket immediately. Once oil prices soar, gasoline, airfare, and logistics costs across the entire US will follow suit. What does this mean? It means inflation is back with a vengeance. Over the past 2 years, the Federal Reserve has gone to great lengths to bring inflation under control. Just as inflation data is finally looking promising and the Fed is preparing to cut interest rates, a single shot in the Middle East sends oil prices back to $100 a barrel, enough to make Fed Chair Powell's face turn green. If inflation won't come down, the Fed won't dare cut rates and may even have to maintain high interest rates. With interest rates remaining this high, the valuations of those tech stocks in the US market, which rely on telling stories about the future and boast price-to-earnings ratios of dozens or even hundreds of times, will be instantly crushed. So, friends, have you noticed? The ultimate weapon with which the US-Iran conflict strikes the US. Stock market isn't military destruction at all. Rather, it creates a stagflationary environment of high oil prices coupled with high interest rates. This is the number one killer of the US. Stock market. Section 3. A historical review. How did the stock market perform during wars over the past 50 years? Hearing this, some might say, that's it. As soon as war breaks out, the stock market is doomed. Wrong. Completely wrong. Let's look at the historical data. Over the past 50 years, through several major conflicts, the performance of the U.S. stock market has not only varied, but has, on several occasions, been surprisingly resilient. The most devastating was the 1973 Yom Kippur War. On that occasion, Arab nations imposed an oil embargo in retaliation. Oil prices quadrupled. The result? The S&P 500 plunged nearly 48% over the following year. This was a classic case of inflationary carnage, oil supply cutoff, stock market bloodbath. But look at the 1991 Gulf War. Before the war began, the stock market fell for several months as panic set in. Yet, on the very day Operation Desert Storm kicked off, U.S. stocks didn't just avoid a decline, they surged dramatically, ushering in a bull market that lasted for years. The 2003 Iraq War followed the exact same script. In the month the war began, the stock market bottomed out and rebounded immediately. Why is this the case? This brings us to a famous Wall Street adage, buy on the sound of gunfire. What capital markets hate most is uncertainty. The stock market suffers the most during the back and forth of whether a conflict will break out or not. Once the dust settles, even if it's bad news, the market will begin to rebound as long as it can calculate the cost. So, if we distill historical experience into a single sentence, it would be, if a war is merely a geopolitical skirmish that doesn't completely cut off oil supplies, the deep troughs the market plunges into will, in hindsight, all turn out to be golden opportunities. But if a war triggers a prolonged, severe energy crisis, don't rush to buy the dip. Section 4. Major sector divergence. Who's profiting and who's taking a beating? All right, let's assume the conflict continues to fluctuate at its current intensity. Instead of betting on the overall market's ups and downs, what will happen within the stock market itself? 4 words. A world of contrasts. Capital is incredibly smart. It will shift positions as swiftly as a startled bird. Who are the absolute winners? It's the old economy. First up are traditional energy stocks. As soon as geopolitical tensions flare up, even a $10 spike in crude oil sends the free cash flow of these oil giants soaring to mouth-watering levels. Next is the military-industrial complex. What drives modern warfare? Money. A single interceptor missile costs millions of dollars, and every launch comes from a Department of Defense contract money that ultimately flows into the financial reports of defense giants. There's also a hidden winner: cybersecurity. Modern conflict isn't just about conventional weapons. It also involves hackers attacking each other's infrastructure. As a result, shares in top cybersecurity companies are often bought as safe haven assets during such times. So who gets hit the hardest? First are airlines and cruise lines. Fuel accounts for the lion's share of their costs. When oil prices rise, their profits vanish instantly. Second are non-essential consumer goods. When people spend more on gas, they naturally have less money left for clothes, new phones, or travel. Third are those second and third-tier tech stocks that aren't yet profitable and are propped up purely by hype. In an environment of persistently high interest rates, they're the first to be abandoned by investors. Section 5. The retail investor's fatal flaw. Why do you always lose money during crises? Now that we've covered the macroeconomy and the market, we need to shift our focus back to you. Why do retail investors always suffer the most during these geopolitical crises? Because most people make the same fatal mistake. They let their emotions take over and lose their sense of order. You watch the news. Today it says retaliation is imminent. So you panic and liquidate your entire stock portfolio. Tomorrow, when reports say all sides are exercising restraint, you rush to buy back at inflated prices. The day after, seeing gold hit a record high, you think it's a safe haven asset and, in a fit of excitement, go all in on gold bars. Is this investing? No, this is handing your money to the market. The biggest disadvantage for ordinary investors is that your information is always a step behind that of institutions. By the time you see the news, the market has already priced it in. You think you're hedging your risks, but in reality, you're just catching the falling knife. Gold can indeed serve as a safe haven, but the right way to buy it is to accumulate it gradually during times of peace, not to buy at the peak when the world is in turmoil and everyone is scrambling to buy. Moreover, many people fail to consider their cash flow. They put money meant for next month's mortgage payment or emergency medical expenses into the highly volatile stock market, only to be terrified by a market correction and end up selling at rock-bottom prices. This is a classic case of turning a matter of survival into a gamble. Section 6. The Ultimate Asset Allocation Guide. The Anti-Fragile Dumbbell Strategy for Ordinary People. So, faced with these major global trends beyond our control, how exactly should ordinary people allocate their assets? I'm going to share a dumbbell strategy that will let you sleep soundly. What is a dumbbell? It's heavy at both ends and light in the middle. One end of the dumbbell represents absolute defense, known as keeping enough ammunition. Allocate 20% to 30% of your total capital to extremely safe assets, such as short-term US, treasury bonds, money market funds, or even just bank deposits. Then, allocate another 5% to 10% to physical gold or gold ETFs. The purpose of this portion of your funds is not to beat inflation, but to provide a psychological safety net. When others are despairing over a stock market crash, you'll look at the steady cash and gold in your account. Not only will you remain calm, but you might even feel a bit excited because you'll have the funds to pick up blood-stained chips. The other end of the dumbbell represents a long-term offensive strategy known as investing in humanity's future. Hold on to your core broad market index funds, such as the S&P 500 and the Nasdaq 100. Why? Because the war will end sooner or later, and humanity's pursuit of technological progress and the explosive growth of AI computing power won't stall just because of a few missiles. If the market really does crash by 10% or 20% due to panic, as long as you have that spare cash we just mentioned, don't hesitate, start dollar cost averaging. Turn the crisis into a sale season where you can buy top-tier global stocks at a discount. On one hand, use cash and gold as a stable safety net. On the other, invest in the future through index fund dollar cost averaging. Ditch all those high-risk, hype-driven, and incomprehensible speculative stocks. This is the perfect risk mitigation strategy for the average person, seeking certainty amid the dust of history. Over a century ago, on the eve of the First World War, someone said, "The lights of all Europe are going out. Today, every time air raid sirens sound in the Middle East, there are always those who wonder if the global economy is about to collapse. Fear is a human instinct, but as investors, we must rise above it. You can never predict where the next black swan will emerge, nor can you determine whether international oil prices will rise or fall tomorrow. The only thing we can control is ourselves. Manage your debt and set aside several months' worth of living expenses. Avoid putting all your eggs in one basket, whether it's a single country or a single industry. Allocate your assets steadily into great companies that generate real profits, as well as hard assets that can withstand currency devaluation. War creates noise, but wealth favors only those who remain rational amid the chaos. When the smoke finally clears, you'll find that those who weren't consumed by panic and stuck to their discipline have quietly risen to a higher level in this massive reshuffling of wealth. If you feel this video has helped clarify your thinking, please be sure to give it a like and share it with anxious friends in your circle. We'll continue this conversation in the next episode.